Daniel Binder of Jefferies Company is a Bloomberg best. His recommendations rank among the most accurate for both Walmart and Home Depot. And he joins us now from his firm in New York with his take on today's earnings reports. Daniel, welcome to Bloomberg News. Always good to have you on.
Thanks for having me.
Daniel, Walmart, is this a question of cost controls and increased international business getting the credit for today's number?
Well, I think you had three things that contributed to Walmart's performance today from a stock perspective. First, you had sales that, although negative, were less negative than I think some of the concerns that were increasing out there. Two, the company took full-year guidance up by 3 cents on the low end and 2 cents on the high end. And three, they endorsed or continued to endorse this idea of positive comp store sales during the holiday season and fourth quarter. And I think that is where they're getting credit today.
You, according to a note, you guys are still recommending Walmart shares, and you say here that that's based on the idea a reversal of flawed merchandising decisions that caused self-inflicted pain will be corrected. Specifically, what were you talking about?
Well, specifically, Walmart, under different management in the U.S. merchandising, had made some decisions over the last 12 to 18 months that, in theory, seemed like the right decisions at the time, but I think in reality proved to be a detriment to their sales. Mainly, they had pulled thousands of SKUs out of the store across many categories. Inventory levels came way down, and I think as a result, they became less relevant to the consumer in certain categories. So now we're in the process of basically lapping those easy comparisons, making the decision to get back on the track, getting those SKUs back in the store. And I think this quarter we saw that most clearly in the food category, which I think was probably up in the sort of the mid-single-digit range.
But we did see total revenue at U.S. Wal-Mart stores falling, fewer customers going into the stores, correct?
Yeah, what you're seeing right now is sort of a less bad situation. Yeah, we don't just make that flip overnight. We're seeing less bad traffic trends. We're seeing categories where they were able to add SKUs back more quickly, like food, showing a bounce. We had flattish performance out of food last quarter. Now we're looking at sort of that low to mid-single-digit improvement, and I think you're going to see other categories come along over the next 12 months.
And Daniel, quickly, in about 30 seconds, let's talk about Home Depot. They were up nicely as well. What about their ability to control cost, considering that the sales growth was somewhat tepid?
You know, I think that Home Depot has demonstrated quarter in and quarter out that they have internal profit drivers to drive earnings growth, which has been augmented by share buyback, heavy share buyback activity. And I think when you're looking at the top line growth, it was actually probably a little bit, it was in line with consensus, but I think the informal expectations may have been a little bit lower given what the vendor community was reporting over the last few weeks. So sales looked reasonably good, but amid softer sales, you are seeing good SG&A management. You're seeing good pricing, grid pricing work, essentially maximizing profitability, reducing markdowns, and improved distribution efficiencies.
All right, Daniel Binder, Jefferies Company, joining us to talk Walmart and Home Depot. Dan, thanks.